SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Good afternoon and welcome to this SUERF BAFFI Bocconi webinar. Today we are discussing one of the most consequential changes in financial markets over the last 1.5 decades. So many segments in financial markets rely on so-called dealers or market makers to intermediate, so to match buyers and sellers. And this intermediation is essential for market liquidity and more broadly market functioning. Historically, these dealers were mostly global banks, and these global banks were actually so powerful and important that in the 1980s, a US writer used the term the masters of the universe for these investment banks. In the last few years and last decade, however, in particular, electronic trading has advanced to very high levels so that in most markets there is no more the trading on the exchange directly, but via electronic platforms and therefore also via algorithms. This is true not only for equity, but also for government bonds and the foreign exchange market. In parallel, we've also observed after the global financial crisis, major structural changes in the balance sheets of banks. Banks have been forced to hold much higher levels of capital and liquidity, and this has led them to adjust their business models, in particular in our context, to streamline their market making and trading. So both of these trends together, electronic trading and adjustments at banks, have led to the rapid rise of principal trading firms. Principal trading firms are non-bank dealers who often use algorithms or other programs to use electronic platforms for market making. So typically they do not take outright positions, but rather buy and sell during the day. Their inventories overnight are typically quite small. And these firms are now the core liquidity providers in many financial markets. So as a result, market liquidity and much broader market functioning, which used to be driven by the activities of major investment banks, has now moved to the principal trading firms. And these non-banks typically have rather small balance sheets compared to banks and also limited capacity in stress periods. So market functioning nowadays depends on these firms, and we see case studies, and one of the most important case study in the US Treasury market, which is under recurring stress. And so these are the topics which we are going to discuss today. And we have brought together 4 senior experts, both from the industry, but also from the public sector. And I will now hand over to Karolina, who heads the Swedish Debt Management Authority, to start the panel.
Well, thank you for that, Martin, and a warm welcome to this webinar from my side. Let me start by introducing the 4 highly distinguished colleagues that are with us here this afternoon for the panel. So let's begin with Tarek Tranberg, who is Head of Government Relations at Optiver. Now, he has extensive experience in the private sector, for example, as Head of Public Affairs and Policy of the European Association of Corporate Treasurers. He holds a master's degree from the London School of Economics. Then we also have Steffen Kern, who is Chief Economist at ESMA, that is the EU's Financial Market Regulatory and Supervisory Authority. He has been so since 2012, so almost from the outset, and he leads ESMA's analytical work on financial stability, market integrity, institutional investor industry, as well as financial market infrastructure. He is also a professor who teaches financial market development, risk and regulation at the University of Mainz and the Leibniz Institute for Financial Research in Frankfurt. He holds a doctor's degree from Erasmus University. Then we have Dylan Walsh, who is partner and global head of corporate and institutional banking at Oliver Wyman, a company he joined in 2006. His core areas of expertise are capital market strategy and transformation, stress testing and capital planning, financial resource management, and regulation. He holds a master's degree from Tufts University and an MBA from the Tuck School of Business at Dartmouth. And finally, we have Matthias Graulich, who is Chief Commercial Officer and Global Head of Products and Markets at Eurex Group. He joined the Deutsche Börse Group in 2001, and since then he has held a number of management positions at Deutsche Börse as well as Eurex. He has an MBA from Duke University. This constitutes our distinguished panel today, and I would now like to start with Tarek to set off the panel. Now, Tarek, you are working in a major European principal trading firms. So can you please share your view on the business model of these kinds of firms? What is it that they actually do?
Thank you very much, Karolina. Happy to do so. The plan from my side is a little bit to give a bit of background on Optiver specifically, and then give a bit of a sweeping view on general characteristics across principal trading firms or market makers. I'll use the terms interchangeably. And then also try to describe to the best of my ability what the role of a market maker in modern financial markets is, and also go a little bit briefly into the regulatory setup that we operate within. So very quickly, in terms of background on Optiver, so Optiver is the oldest market maker that is in operation today. We've actually celebrated our 40th anniversary this week, so we've been around for 40 years. We are headquartered in the Netherlands, in Amsterdam, but operate across 10 other major jurisdictions across the globe. We are privately owned as a company, and one of the main characteristics that also distinguishes most other principal trading firms also holds true for us, which is that we trade with our own capital at our own risk. So we deploy our own capital for our liquidity provision activities. In terms of the asset classes that we trade across or supply liquidity to markets in, that's predominantly in the listed space and covers anything from equity-linked products, so that would be equity options, index options, ETFs, underlying cash equities, to fixed income products to the extent that they're listed on exchange, so that would be the fixed income derivatives. So you would think of your Bund, Bobl, Schatz options, or the fixed income futures, so futures on government bonds, or the futures on the options on government bonds, as well as commodity options and foreign exchange. So across all of those asset classes, we supply liquidity to financial markets across the different jurisdictions that we're active in. So maybe if we can go to the next slide, I've set out a few characteristics that generally hold true for the majority of principal trading firms or market makers. I've alluded to it already in the intro, but the general point that holds true is that market makers deploy their own capital to supply liquidity to the market across the products that they're active in. Normally, what you need for this is state-of-the-art technology that fuels your pricing methodology and your risk solutions, so that you're actually able to price the instruments that you're providing liquidity in accurately, and that you're able to take on risk from the market and facilitate the risk transfer of other market participants. And then finally, you need sophisticated technology solutions to both deploy your trading infrastructure on the exchange, but to also operate your risk management internally as a firm. Now, some principal trading firms also trade against institutional counterparties, so that tends to be a non-agency relationship, whereby large institutional investors are looking for liquidity in larger size, which tends to happen in what we call off-screen inter-dealer markets, which are linked to the exchange but are separate from the central limit order book. And generally speaking, to the extent that trading happens on exchange, principal trading firms or market makers are under quite stringent obligations from the exchanges in terms of the pricing requirements, in terms of what kind of spreads you're mandated to show in the order book, and in terms of the amount of time that you're supposed to be in the market to facilitate the trading interest of other participants. And obviously, by doing so, by having quotes constantly in the market, you're putting your own capital and your own balance sheet at risk. So therefore, you require sophisticated technologies to manage that appropriately. If we can go to the next slide, then I can talk a little bit more broadly about how market makers fit into the wider ecosystem of financial markets. So broadly speaking, I said before, and if you can think of a market maker as a sophisticated pricing engine, collects inputs from all from events or from trades that have happened or from macroeconomic developments or speeches by central bankers, you name it, anything that has the capacity to move markets or have an influence on the fair value of an instrument is consumed by a market maker and fed into the pricing model that a market maker operates. And as a result, a market maker decides how they will price a given instrument and what kind of quotes, so a bid price and an ask price, they will show in the market across a whole range of instruments. Now, you'll be doing this across hundreds of thousands of instruments. I checked this morning, I think in our European office alone, we price around 500,000 instruments on a daily basis. So it's across because you don't only look at the instrument level, but you also have, especially if you're trading derivatives, you'll have multiple different strikes on the individual instrument. So you'll be exposing your capital and your balance sheet to risk in the market across an extremely wide range of instruments to supply liquidity to the market and facilitate the trading interest of other participants, whether that's to buy or to sell the instrument. And that can be anything from institutional investors who come to the public market or brokers who are coming to the public market and passing through retail orders that sit behind them. If it's on a central limit order book, of course, as a market maker, you don't have visibility on who you trade against because it's anonymous. At least on European markets, it's anonymous. So we don't know as a liquidity provider whether we are trading against institutional counterparties or retail investors or brokers who are passing retail orders through. Now, if it's in larger size and in the inter-dealer market, then we have a clear idea. If it's institutional investors who come to us asking for a price or direct liquidity, then we obviously have a good idea of who it is that we're trading against. But overall, what holds true is that to be able to facilitate that risk transfer in the market, what you need to have is a balance sheet that you can deploy and take on risk that you can then manage over time, which is especially important in periods of market stress or periods of market volatility, that you have that balance sheet available that you can deploy and that you have that capital available that you can deploy to meet the demand for liquidity that usually is quite high in volatile market scenarios, especially when other market participants pull back from the market in a risk-off scenario. And ultimately, what that does is to facilitate the proper functioning of the market, because it means that you don't have large price dislocations in any market circumstances, because ultimately the job of a liquidity provider is also to remove any price dislocations. So when we see that the relative value between instruments is not what it should be, market makers tend to move prices back in line or adjust their pricing across the whole range of instruments that they price to move these discrepancies back in line. And it all comes back to that principle of, you use your balance sheet as a method to warehouse risk, and you drive price formation in the public market or in the order books by competition between liquidity providers. Obviously, we're not the only ones who are active as liquidity providers. So the way the liquidity provider fulfills a service to the market is that there's multiple of us or multiple market makers active in a given product at a given point in time, competing with each other in terms of providing best bids and best offers, which then ultimately means that bid-ask spreads tighten, delivering better outcomes for end investors who are then able to transfer more risk at a cheaper price at the top of the book, if you will. And the same holds true for price formation in the off-screen inter-dealer markets. Generally, and this is obviously the case for listed markets, market makers will operate under the responsibility of what we call a general clearing member. So that will be a global clearing bank that will provide clearing services to a market maker. What that means is that the portfolio that you hold as a market maker via that clearing member is margined on a real-time basis by that clearing member. So you supply margin to your clearing member, and the clearing member then obviously is the one connected to the CCP, so the central counterparty, and passes that margin on through there, and also fulfills another function of guaranteeing all the trades that the market maker has done to the financial market. So in the event that a market maker were to be in trouble, there have been very few occasions of that happening, the clearing member would actually guarantee any trades done by that liquidity provider to the rest of the market. And this is completely separate from the regulatory capital requirement, which sits on top of that from a market maker's perspective. And I'll come to that in the end. And the baseline of everything, and I've said it before, is around state-of-the-art technology. So you need to have developed state-of-the-art technological solutions, both for your infrastructure that you deploy on the exchange. You need to operate sophisticated technology for your pricing methodology and for your trade execution and for your risk management to be able to operate at the level that is required in modern financial markets, and to also meet the demands of exchanges in terms of liquidity provision and the demands of, at the end of the day, end investors in terms of their expectation for their ability to transfer risk at certain volumes in the market at any given point in time. I think we can skip the next couple of slides. So I've spoken to them already, so that's a little bit of an overview of some of the products that we trade. And here ultimately is just a summary of the main elements that it takes to really function as a global full sort of scale liquidity provider, which is, it all comes back to the core aspects of pricing, trade execution, and risk management, which are key in terms of operating a liquidity provision business across correlated or uncorrelated asset classes across the whole globe. And then ultimately with the purpose in mind of narrowing bid-ask spreads and facilitating the trading interest of other market participants. And maybe I'll finish just on the regulatory wrapper, also so I don't run over time. And that will be the next slide, which is so separately in terms of how market makers, and obviously I can't speak to every single firm, but how market makers in Europe are supervised. We fall under dual regulation, if you will. So we are licensed as a MiFID investment firm. The only license that we have is the deal on own account. But we are also prudentially supervised under something called the prudential regime for investment firms. So that's the Investment Firm Regulation and Directive. And concretely in Europe, that means that we're dual supervised by the Dutch Central Bank and the Dutch Authority for Financial Markets. And on the prudential side, that actually means that our Pillar 1 or our regulatory capital requirement, which sits on top of the clearing requirements that we have, is actually derived from the banking models. So we use, for instance, the banking model for calculating our capital charge for market risk, which for most principal trading firms or market makers actually makes up the majority of their Pillar 1 requirement, given there's barely any other risk types that we have to capitalize against except operational risk. So for those, we actually use the banking methodologies today. And then we are obviously in all the jurisdictions that we're active in, we are separately licensed and individually supervised as well at the local entity level by those regulators. So that's just a bit of an overview on the left-hand side across the jurisdictions that we're active in, where we're directly supervised by the relevant authorities. And that's a little bit what I wanted to cover as a sort of brief snapshot. Obviously happy to take questions, but hope this was useful as a bit of a lightning round intro to the business of market makers and how we operate.
It certainly was. So thank you for that, Tarek. And you made a perfect bridge over to our next panelist, which comes from the regulatory and supervisory side, Steffen. from ESMA. So ESMA is an authority that has been extensively analyzing market functioning and these kind of firms. So what can you tell us about ESMA's work and your views about the regulation of these kinds of entities? And maybe you also want to say something about their potential impact on EU systemic risk. So the screen and sound for these webinars is yours, Steffen.
Karolina, thank you so much. Thanks also to Martin and Ernest for having us, ESMA, participating in the seminar today. It's a great pleasure in two respects. First of all, of course, it's an opportunity for us to share a little bit our work in this space, especially from a risk analytical perspective, a work where we are in the middle of exactly measuring, finding out the role of principal trading firms. So this is an exciting moment of time for us, and that gets me to the second reason why this is important for us to be able to speak to you, which is that we are still always, in principle, in a learning situation. We need to find out how these very fast-moving markets, Tarek mentioned this, technologically fast-moving markets evolve and what impact they have both on the broader market environment, but also on our activities as regulators, supervisors. I'll share with you a few slides, and I hope that you can actually see these slides already full screen. And let me, first of all, say a couple of words on where ESMA should be located in all of this. And on the, I think, last slide that Tarek shows, the organization showed somewhere. It's very impressive how your company is actually supervised to see that network and the environment of the overall regulatory and supervisory community. What is very important and was very visible in Tarek's exhibit there is that ESMA is not a direct supervisor of the activities. This is direct supervision of these activities rests with national authorities, and they actually execute the regulatory framework that prevails in the European Union. Mainly MiFID, of course. Most of you here on the call would have heard this about this framework. And it is this regulatory framework that the European Union at EU level devises. And where a place like ESMA comes in, we try to, first of all, actually advise on the implementation of the MiFID framework. This is what we do continuously through different regulatory technical standards and so on. And also we provide and facilitate supervisory convergence in the space, i.e. help national authorities to align their supervisory practices such that they can then, through that, in turn support the single market in the European Union for these products. So this is where ESMA comes in from a regulatory and supervisory convergence perspective. And this actually then, drives a lot our assessment of the way we assess these markets. Now, clearly, principal trading firms are a big topic at the moment. We today have the pleasure of focusing on their activities in sovereign bond markets in particular, because it is there that these activities have recently made quite a bit of headlines. And the reason why and how we look at this is twofold, if you want. I mean, first of all, it is, and Tarek already alluded to that, it's a lot about liquidity in the market, right? Liquidity provision and the way liquidity evolves in the market and is available, in particular, of course, from our perspective as regulators, supervisors, liquidity in situations of distress or of market turmoil. This is one perspective we look at this. And the second one is the perspective of the technology that comes into play here, i.e. in particular algorithmic trading, high-frequency trading, and this is something that we've looked at as ESMA for a while now, and we have seen how important, first of all, the impact of high-frequency and algorithmic trading firms can be, and most principal trading firms actually belong to that group. And also, it is clear that that they exert through their trading activities a big impact on the liquidity provision across marketplaces in the European Union in the single market. And this is an important thing. You know, of course, optimally speaking, we're thinking of a single market. At the same time, we look also at a lot of fragmentation between trading venues, for example, and so on in these infrastructures. So it's a big question of how does the behavior of one market participant in one market impact the evolution of prices and liquidity in another market. So from a market order and financial stability perspective, this is extremely important for us to look at this. So technology, you see that on this slide, is a first driver in this thing. Another point that we are observing with great interest is the evolution of the business model. So the reduction in market making activities by banks on the one hand, and then the transformation of high frequency trading firms into PTFs. This is one thing we are looking at, and then there is ample evidence of this one, the substantial role played by principal trading firms in many market segments. First and foremost, of course, equity, foreign exchange, futures, bonds. You have the regulatory framework and context in which all of this happens is, of course, MiFID I and II, the more strengthened framework in the European Union, which aims to enhance and promote competition amongst venues and amongst trading firms. So this is the setting in which it all happens. On top of that, we have now in process a consolidated tape for bond markets. This process continues to be rolled out, which will provide a much higher level of transparency in that market. And we have got the supervisory convergence on algorithmic trading that are already mentioned. And then there are much bigger discussions on the regulatory or policy space, which are not yet on the agenda, formally speaking, but where many people, stakeholders in the market, have a strong interest. And that is, for example, potential central clearing obligations in EU sovereign bond markets, which can change the liquidity dynamics quite fundamentally. Now, of course, all of this happens in a context. We now look in particular at sovereign bond markets. These markets are very special in the sense that in the cash segment of the market, there is great heterogeneity in the overall structure of the market, in the way it is set up and the way liquidity provision actually functions. There are different requirements for primary dealers in these markets, which are different across member states and countries. There are different rules on trading protocols, and there is what is common to many markets, a rising share of cross-border request for quote platforms. Then to juxtapose this, if we then look at the futures markets, there it's much more centralized. And to give you an example, there is this central limit order book on Eurex, with a very significant share of the trading undertaken by PTFs, by principal trading firms, many of them actually coming not from EU member states, at least not originally speaking. So this is a very heterogeneous markets against this plays out, and what we find, and these are just very preliminary findings, I have explicitly not yet put any precise figures or statistics on this sheet because we are not at this stage yet. We are working on MiFID data to exactly establish what is going on. But what we can see by and large is that there is an increasing activity of hedge funds in sovereign bond markets, both primary and secondary, and their role is evolving. They're moving from net lenders to net borrowers, including in repo markets. Then, and I think I just saw on the screen the question coming around: what is the official regulatory definition here? And the answer is there is none. It's actually a very complex classification of entities. Principal trading firms, which is a market concept, can encompass a wide variety of entities. Algorithmic traders, of course, we already talked about this, could also be hedge funds. Even family offices go into the market to be market makers. And of course, depending then on which type of entity you are subject to very different regulatory definitions, including you could be an investment firm, a market maker, a hedge fund, or else, right? So this is also a heterogeneous group of players that we talk about, which are under the umbrella, or we usually refer to under the umbrella of PTFs. What is also clear from what we look at is there is a large number of non-EU firms. Most of them actually have a legal entity in the European Union, but the parent companies are outside the European Union. They are very active across a wide range of asset classes, and with that play a role in many markets. And that includes even repo markets, for example, where we see an increasing activity by many of the type of firms that we refer to under PTFs. Overall, there seems to be a very strong presence in futures market, less so in the cash markets. This is initial findings that we have had from our perspective. I'm looking forward to hearing more about the colleagues here on the panel. Very interesting to listen to you, and also I'm looking forward to the discussion. With that, I would first now pass it back to Karolina. Thank you.
Thank you so much for that, Steffen. And then let's turn immediately to Dylan. So a lot of the revenue which the principal trading firms are obtaining today probably used to go to major dealer banks. And at the same time, banks are vital service providers to trading firms in clearing as well as in the provision of repos. So it would be interesting to hear from you, Dylan, how you see the conflicts between dealers and trading firms.
Sure.
Are trading firms taking away? Yeah.
Sure.
So please go ahead.
Happy to take it over from here, and thanks so much for having me and having us provide our perspectives here. So just a little bit of background before we go in. I spend most of my time advising banks, and I think over the past 15 years or so, a lot has happened, and a lot of that has been driven by regulatory change and that feeding through into the business. And so what you'll see here is a little bit of a story around how the revenue pools have really shifted pretty dramatically for the banks in a couple of areas. A lot of that data comes from proprietary benchmarking that we've been doing over the years, but now we do in collaboration with Coalition and Greenwich. So that's the basis for a lot of this analysis. But what we've found that's been really interesting is there's a lot of press coverage now of the revenues earned by principal trading firms, and I don't think all of that's created equal. So if we'll go into this in a little bit of detail as we go through these pages, but what you'll hear from me is very consistent with what you heard from Steffen, which is that you have a variety of different definitions and a variety of different sources of revenue, some of which banks can participate in, some of which banks very explicitly cannot participate in. So it's a little unfair to stack up revenues in any given quarter from Citadel up against Morgan Stanley, because the activities that those institutions can participate in are very, very different. So if we flip the page, we can go through this in a little bit more detail. I think the trading, as we say here, the trading game has changed for banks over the past 15 years. If you go back to 2009, which was, I used it as a starting point for this analysis because that was before some of the Dodd-Frank regulations, and in particular, the Volcker rule came into force in the US. So banks were actually able to make markets in a variety of different ways. They were also able to do prop trading. So at that time in the industry, you would actually see business lines that were either called arbitrage trading or proprietary trading. And those were predominantly in the equities businesses, but they actually, kind of existed across the entire business. So it would also be in many fixed income products. But we illustrated it here with cash trading. The revenue produced, if you include both the pure market making activity as well as the proprietary trading activity, was about $35 billion back in 2009. Today, that's only about $20 billion, and you can see that's been a pretty steady reduction. It's not come exclusively in the form of proprietary trading moving away. That was a big chunk of it. But also you've had a lot of fee compression and the competition in the market that's come from players like the proprietary trading firms and the market makers have probably improved things in terms of an efficiency standpoint for investors pretty dramatically. And that's also bled out some of the revenues from the business. But at the same time, I think the banks have learned to serve this ecosystem in a very different way. And that's where you see this equal and if not greater growth that's come from prime financing, which involves a lot of different things. It's not purely a financing business. It's also the services provided, some of the clearing services provided to a variety of different institutions. So not just principal trading firms, but also key players in the market like hedge funds. But as you can see, that's just about made up for the lost revenues on the cash trading side. And an important dynamic here is this is pretty concentrated. So if you go back to the world of 2009, that cash trading revenue was spread out across a number of different institutions. I think today that concentration of cash trading revenues is much, much tighter in a smaller group of big broker dealers. And the prime financing is even more concentrated overall because it requires a lot of balance sheet, it requires a lot of technology, and a very holistic business model to serve those clients. So very, very long story short, banks have kind of learned to love the PTF space, and if you include hedge funds in that, they've really learned to love that market because it's helped them grow in a very different way, and in probably a more sustainable way. That cash trading revenue would bounce around quite a bit from year to year, especially when you included proprietary trading. The prime financing revenue is much, much steadier and tends to be pretty consistent overall. So if we flip the page, I'll talk a little bit about some of these different players that we see in the market and how they operate in this space. We've said a couple of times that not all of these things are created equal. And certainly the banks have lost some market share in market making as these new players have come into the market and really scaled their business model. But when you see the revenues that are printed in kind of the FT around Jane Street, Citadel, et cetera, that is going to capture a lot of different revenues because we have these kind of hybrid models developing. So if I can just clear the page on the left-hand side so you understand what we're looking at here. This is really the value proposition of the different players in the market on the vertical axis. And then on the horizontal axis, that's the level of risk warehousing that goes on. So when you tend to find these quant hedge funds and more traditional long, short hedge fund strategies, they warehouse risk over a long period of time. They use a lot of capital to do that. As you move to the left-hand side of the grid, then you see much more algorithmic intraday risk taking versus something that happens over multiple different days. And and kind of the quintessential example of that is Virtu, who really doesn't try to hold any risk from one day to the next. And what's emerged is there's a lot of these hybrid players that are operating in between. And so as players like Citadel and Jane Street evolve their model, and frankly, many other principal trading firms evolve their model, they're actually taking more risk. They're deploying strategies that look a lot more like hedge fund strategies. And so what we've tried to do is say, what are the things that banks can actually do? What are the activities that banks can do? And what does that market look like in terms of the revenues being generated by principal trading firms? And overall, we see that market as about a $40 billion market overall. It's not the whole of the industry. And that's pretty large. The principal trading firms, I think, make up about 50% of that. And we could see that evolve up to about $110 billion. And what's really going to drive that evolution is new asset classes coming into the coverage universe. But that doesn't include a lot of this activity that I described that's more hedge fund-like. That's a totally different universe. And we try to keep that separate when we try to do these side-by-side comparisons. So when you say that market making revenue has gone away from the banks and gone to new players in the market, the truth is it definitely has, but it's also there's also a much bigger universe in which many of these players are operating, and they're very diverse. So you have these various different types of players competing in that space. So, the takeaway here is that really these headline revenues from the principal trading firms are driven by activities that in many cases are beyond the scope of what banks could do today, and frankly what they want to do, because I think they've shifted their business model where they're very, very happy to operate in this space and not do the level of risk taking and invite the volatility that they had in their revenue streams quarter to quarter. So the final page here, and then we can pause and kind of open up to questions, although I think we'll take those at the end, is, how are the principal trading firms actually winning in the bank's backyard? Because when you're talking about competing against a JP Morgan, a Goldman Sachs, a Morgan Stanley, those are very, very strong players. They're very well funded. It's kind of remarkable that anyone would be able to compete with them in this space, given how established they are. But they're competing on pretty different terms. And so if you look at this page, we've kind of classified the world into the tier 1 banks that I just described, the tier 2 banks that have smaller broker-dealer businesses, and then the principal trading firms. And frankly, the principal trading firms have a big advantage on regulations. We talked about it before. They can still participate in some of these activities that the banks cannot, or the banks are at least somewhat limited in what they can do. And they have to hold substantially less capital against those activities than the banks necessarily would, at least in some areas. The other big advantage that you hear a lot about is technology. It's very important to recognize that banks, as they deploy new technology, go through a pretty onerous compliance process, and it's relatively slow moving. And this is in no way to indicate that the principal trading firms don't have very, very robust risk and compliance controls. They indeed do, but they can move much, much faster to market in terms of rolling out new algorithmic trading strategies, new technologies, and they really stay at the cutting edge in meaningful ways. And the banks just move a little bit more slowly in being able to keep pace with that. There are deep pockets on the tier 1 bank side, but nevertheless, it is a slow moving process. And it's one of the most common questions that we get from the banks is, how do we operate our technology organization, and how do we get new products to market the way that some of these top tier principal trading firms and market makers do today? And then the last piece is around talent. And talent is obviously, in the financial services industry, attracted by compensation. And typically the compensation that you can achieve in a principal trading firm, especially if you're more on the programming and strategy side of things, is orders of magnitude higher than what you would be able to achieve in the banking landscape. So they are able to attract some of the top talent overall. And that's what really defines the competitive balance. So the PTFs have really been able to use that to establish, where they're going to compete in the market and create a little bit of white space between what the banks can do and what they can do. On the flip side, the tier 1 banks have very, very broad asset class coverage and can basically do everything that a client, wants to see from them. And as a result, they've been able to maintain a much stronger client franchise overall. Principal trading firms historically have not focused intently on building a large institutional and certainly not a corporate client franchise. That's starting to change in some areas, especially with like agency and outsourced trading options. But I think in general, what you're going to see is the tier 1 banks have a much deeper and more stable client franchise that they can tap into, and that makes for different ways to monetize the capabilities that those banks have. And so this is where this real equilibrium has settled in, where the banks have remained pretty dominant in terms of client service and asset class coverage. The PTFs, where their business model really, really works effectively in certain spaces within asset classes or across entire asset classes, they've become pretty dominant, and they've kind of sketched out those spaces. in the middle ground are these mid-tier banks that kind of have been stuck. And I would say most of what's kind of bled away in terms of revenue and market share has come from these middle tier banks that had historically participated in a lot of these activities, but just on a smaller scale from the big players. They've lost a lot of share and really dropped to the point where they're questioning whether to stay in certain businesses. And I think they're getting some help from their friends on both the left and the right on this page, in the sense that the outsourced trading offerings that are starting to come to market are basically allowing them to continue to serve their clients with a broad set of tools, but they're doing those through sort of a white label option overall. So that's just a little bit of a flavor of what we're seeing from the big players in the market and how that's evolved. And I would say, in general, if you look at the market today, banks are pretty happy with how things have landed, but certainly not complacent.
Well, thank you very much for that, Dylan. Very enlightening. As our last speaker in this first round for the panel, let's go to Matthias. You have a background in central clearing, and trading firms are major clients in central counterparties. So how do this type of financial infrastructure approach the trading firm sector, and how do they manage the risks of high frequency trading? Matthias.
Thank you, Karolina, and warm welcome also from my side, and thank you to SUERF for the invitation to speak today and discuss with my fellow panelists this interesting topic. While a lot of my career I spent on the clearing side, Eurex has two aspects, right? Eurex has an exchange trading arm. Eurex is the largest European derivatives exchange and one of the largest globally. And at the same time, we have within our group Eurex a CCP, Eurex Clearing, which is one of the largest CCPs globally. And if you look back almost, 35 years, the root causes or the basis for these kind of principal trading firms, the basis was laid down because electronic trading started. Eurex was a pioneer in this, bringing electronic trading into the derivatives world. Way ahead, electronic trading took place in cash markets. And this was all the way back to the early 90s. And I create in a second a bit the link why this was a prerequisite for these firms to grow and how this developed. I think looking at the product scope, on the Eurex side, we cover a very wide range of products from futures, options, but also repos and cleared swaps. My focus today will stay on futures and options, so electronically traded derivatives, where today, and that is what I definitely can say, principal trading firms play a very, very important role in this ecosystem to provide liquidity in these products, in particular in the futures, but also more and more on the option side. And this interplay between a modern financial market infrastructure consisting of a trading and a clearing layer and these trading firms is based on a mutually beneficial relationship. And the grounds, I alluded to it, are based on electronification of derivatives markets. They are based on advancements we have seen in the trading technology. And of course, and I think Dylan alluded to it earlier, the aspect of capital constraints in the traditional bank environment, which has, of course, created room for these firms to grow. They are competing based on technology, primarily, if I look at it from a Eurex perspective. and they are running very analytically driven strategies. And if you look, for example, on this chart here, you see that the share of proprietary trading firms and liquidity providers is very significant in listed derivative markets. And that is where the group is playing a very important role. But you also see on this chart under the P account, there are still the banks listed, the house activity of the banks. And I come back to that in a second. Now, if we look at the next slide 3, we see a bit market structure, and what we differentiate here on the right hand side is the different products, so equity index derivatives and fixed income derivatives, and we differentiate what amount or what percentage of business is executed in an order book and what percentage is executed outside the order book, so via an alternative execution protocol, via a voice broker, via RFQ, and so on. And you see that the shares of order book trading on the fixed income side, for example, are in the ballpark of 90% and very stable at 90% since over the last more than 10 years. On the equity index side, the percentage is 75%. And then if you look on the right hand side with the options, this share is significantly lower because these products are significantly more complex, and you have a much broader set of products, which then requires capital or more capital to make markets and provide liquidity in these products. And this is where in our environment, while proprietary trading firms play a very important role, there is a coexistence. There is a coexistence with the dealer banks. And I would say that the proprietary trading firms have their strength clearly in order book trading, whereas the banks are probably still very strong when it comes to less liquid products, when it comes to large size transactions where they need to warehouse the risk over a certain period of time. But what is also observable is there is a clear convergence observable. A convergence in a sense that proprietary trading firms open up direct relationships to clients to do bilateral transactions with them. So a traditional business which has been with the banks or with the dealer banks. On the other hand, dealer banks are seeing these dynamics and moving also and upgrading their technology capabilities in order to compete in an electronic environment on a kind of on a selective basis, not on a broad basis, but on a selective basis where they see a business for them to position. Moving on to slide 4, what we see here is 2 aspects why this mutually beneficial relationship between, on the one hand, the market infrastructure, and on the other hand, principal proprietary trading firms is important. We have this resilience element, and we as a market infrastructure provide a technology stack which must be very, very resilient for these players to play and use their competitive advantages, which is again technology based and latency based. And we have on the 3rd of March, and this is a brand new number, I have to say, we had an all-time record with 31 million contracts traded on a single day. What we see on a regular day is more 7-8 million contracts. But what is even more important, because to emphasize this technology element, is we had processed on that day over 8 billion system messages, 8 billion. And this is at the end what comes primarily from these electronic trading firms, principal trading firms. And this is where we as a market infrastructure need to be extremely robust and resilient to cope with these requirements. On the other side, we see a very strong liquidity provided by these firms, not only by these firms, but also to a significant degree provided by these firms. And we see this on the right-hand side in the charts. And just looking at the Euro Stocks example, we simulated here that someone would want to do a 10 million notional Euro Stocks future. And you can see that this blue line is the market impact. So this is the cost for executing that order based on crossing the bid offer plus the market impact, which is linked to the size of the trading interest someone has. And you see the minimum cost is crossing the bid offer, which is one tick, which is 10 euro. And then you see this blue line kind of oscillating between 10 and 11. So you see the market impact is only up to, say, on average 10%, which means there is such a significant liquidity in the order book, which is stimulated by these proprietary trading firms, which allows you easily, without any material market impact, to do a sizable order of 10 million. Now, looking at the next slide on the stressed markets, what we see here is, and there is always a discussion on these proprietary trading firms acting with algorithmic trading, and then we have all these negative implications like the flash crash we had back in the day and other things. And here it is very important that the environment, the market infrastructure, in that case Eurex, provides is addressing these topics with market protection measures, and volatility interruption is one of the important measures, where we say if something goes too fast, we stop, or that we have auctions where we concentrate liquidity at certain points in time, and of course then certain rules which we apply in stressed markets to allow a continuously functioning markets without any disruption. And the interesting chart on the left-hand side is an indication that the higher the volatility in a market, the higher is the share of order book activity, which is quite interesting that people see, in particular in the liquid benchmark products, a safe haven, if you will, to trade in an anonymous all-to-all order book environment. Now, looking at the last two slides, slide 6, risk management plays a very important role in this, and this is where the CCP comes in, where we talk about real-time risk management, but where we also talk about portfolio margining and netting of risk exposures. And this is very important, this CCP element, because it not only reduces systemic risks, but it also delivers capital efficiencies for these liquidity providers in order to scale their business and deploy capital in the most efficient way. But on the other hand, what I already alluded to is to reduce systemic risks and manage risks by margining positions in an appropriate and real-time fashion. So just moving on to slide 8 with the key takeaways, and just summarize again what I said earlier. Proprietary trading firms have become a very, very important participant group in electronic markets, in electronic derivatives markets in particular. This all is based on a resilient and scalable infrastructure, both on the trading and the clearing side. We're talking about a lot of technology aspects here. And our proprietary trading firms, the masters of the universe from a trading perspective, I think they have definitely complemented the trading environment to make it more attractive, to make it more liquid, and to bring more activity into these kind of secondary markets. And I clearly see this coexistence with the dealers with some level of convergence. Thank you. Back to you, Karolina.
Thank you so much. That was those were very good introductory remarks, and now we have half an hour for a Q&A sessions, and of course the participants that we have with us online are more than welcome to post questions in the chat. I have a number of questions. Most of them seems to be from Ernest, but I'll give you the floor back here in the same order as you have spoken. So then you can, I'll give you a question from the chat, but you can also choose to address and react to what the other panelists have brought to the table. So let's begin with Tarek then. I think that one of the questions from the chat that you might be well posed to answer is the one from Ernest, where he asked for concrete examples illustrating how principal trading firms are regulated or constrained in their business through rules and regulations. But again, you are also feel free to respond to what you have heard here today. So Tarek.
Yeah, very happy to. Yeah, I think maybe I'll pick up on a couple of themes, and one of that is going to touch on how, and I can obviously speak mostly from the perspective of a European headquartered but globally operating market maker, how we are regulated and constrained by such. So maybe just a more broad remark, and this picks up on a couple of points that Dylan made in his overview of sort of how banks and market makers complement each other. I think for once, for maybe a first remark, I think if I'm not mistaken, the numbers you looked at and the presentation was fairly US centric, so it's not entirely applicable to the same extent to the European market. I think there's a bit of nuance there in terms of how the landscape looks on the European side. I think one point would be that, as far as I'm aware, prop trading by banks in Europe is not restricted to the same extent that it might be for their US counterparts. We don't have the similar restrictions in Europe. And then the next point picks up a little bit more on that technology investment appetite. I think from our perspective as a market maker, we view ourselves very much as a specialist. So the only thing that we do is provide liquidity. We're a liquidity provider, nothing else. We don't conduct client services, we don't do lending activities, we don't do underwriting services, so on and so forth. Obviously, banks have a much broader business model, of which one sub-element is proprietary trading, depending on where they are located in the world. As a result, that also means that being a specialist and only having one business that we run, which is market making, our appetite for technological investments is obviously significantly higher than it would be for a business like a bank that is much more general and has more revenue streams. For us, liquidity provision is the only revenue stream. So if we don't basically have the most nimble, most flexible, and most aggressive approach in terms of investment in our innovative setup, we're basically not going to be competitive anymore in the market. So that also means that our incentives are very differently structured than those of a much more broadly set up business. And I think that then leads me over into what we're looking at from a regulatory perspective. And I would very much push back on the fact that that market makers are less constrained by capital considerations than banks are, at least as far as European market makers are concerned. We, as I said, from a prudential perspective, we largely apply requirements that are anchored in the Basel requirements, actually. So European regulators devised a prudential framework for investment firms, which we fall under, and the vast majority of what actually touches our hard Pillar 1 capital requirements is directly lifted out of the banking model. So in that sense, we are equally constrained, or capital is a constraint in terms of how we can supply liquidity, because it limits our ability to flex into all products or to flex into all products during all market circumstances. So I wouldn't necessarily say that there's a big distinction here. Yes, we have a narrower set of capital requirements, that is true, but it's also on account of the fact that we have a much narrower set of risks that we operate under. The main risks that we operate as or that we have to manage against as a market maker are market risk and operational risk. Market risk makes up about 80% of our capital requirements, and for that, we actually use banking methodologies for calculating our capital requirements. So in that sense, at that level, there is a level playing field between market makers and market makers and banks. But it does mean that because we are more specialized, we have a much better ability to also invest in technology. But I would still argue that capital is very much a constraint for market makers. Certainly when you operate in Europe, not all other jurisdictions have chosen to apply a banking model to market makers. That is true. But in Europe, and given we are consolidated in Europe, we do apply banking methodologies to our business globally. I mean, happy to take follow-up questions as well, or have a conversation on some of these aspects, but hopefully that was clear and also answered your question, Ernest.
I think
just
absolutely. Sorry.
No,
Yeah.
I mean, just looking at Ernest's first question on the liquidity providers and how this functions safeguarded in crisis phases, I think that is a very important question. And I mean, what we are seeing is that liquidity in extreme crisis situations gets lower, and that is what we always observe. But what we need to make sure is, from a market infrastructure perspective, that there is still significant liquidity available for people to trade. And I think there are two aspects which matter. One is there is competition. There is competition taking place between liquidity providers, and if there is flow coming in, they have a natural incentive to show the best possible in order to attract this client flow. The other dimension which we can steer from a Eurex, from a market infrastructure perspective, is the incentive framework we provide for people to show good prices at all times. And that is where we say, for example, you get certain rebates only if you provide liquidity and show prices on the screen, not only during calm times, but also during stressed market conditions. And if someone is not adhering to these protocols, then they also lose the benefit they would get for kind of normal market times. And this is how we try to make sure, with the tool set we have in our hand, that liquidity is available also during these stressed market conditions.
Okay, thank you for that clarification, Matthias. That was helpful. I think, well, in view of what Tarek said about regulation and constraints, it would be interesting to hear from Steffen. And I mean, Ernest also posed this question about motivations for regulating PTFs. There is no depositor protection needed. So are there really is there a need to regulate them as, I mean, or put them into the sort of the standard banking regulatory umbrella?
Well, I mean, at the outset, I think it's important to see that there is no current regulatory agenda around this one. For us at the moment, it is about understanding the market, understanding the risks that are coming our way, and the way of the markets, and to actually then evaluate exactly what this new and growing role of PTFs actually means for the market, right? And when we do this risk assessment, what is, of course, the biggest motivating objective behind it is market order in that sense, right? So looking into the question of what exactly constitutes the market making activity, how far does it go, and we can talk about liquidity provision in distress in a second. But how far does it go? What is the impact on spreads, for example, on the pricing itself, and also what is the cross-venue impact of the activities of any market participants, in this case, principal trading firms. And this then has knock-on effects, understanding exactly how such traders behave in certain market conditions, especially when things get a little shaky, then can tell us a little more about, for example, the effectiveness of the circuit breaker landscape that we have on trading venues that are designed to set in when markets get dislocated, and to really understand, does this system work, right? So that is where the risk assessment around market order comes from. Second, there is a question around financial stability that is more or less tied to that market order perspective, and that has a lot to do with the flow of liquidity across borders these days, in particular also across into third countries, for example, and also the ability of markets to absorb certain shocks as they come. And this is why these days we're looking in particular to sovereign debt markets, where recently the unshakable assumption that there is always ample liquidity has in fact been shaken, and where we need to understand exactly from which part of the trading landscape does the liquidity provision come from, and how resilient is it. Just one word on the liquidity provision in distress. I mean, at the end of the day, it would be great to also hear the views of market participants. It depends a lot on whether a trading firm in the market is actually signed up, formally speaking, as a market maker with a trading venue, right? This is an official sort of contractual relationship that one has with a trading venue on specific individual assets, right? And that contractual relationship then obliges you to, for example, be present with quotes in a certain range of the time across the trading day, for example, to observe minimum rules around the quotation and so on. So that shapes a little bit the market making as we've known it for so many years, and which previously had been taken by banks a lot. When you look back 20 years, when you look at the list of market makers for individual assets, this was all like the major banks, and these days this has changed completely. And that used to be with the banks, but this change is super interesting. In particular, when we look back to the bank-dominated world, I think we should not be sentimental about the market-making ability by banks back in those days. They didn't go into the fire when markets were going crazy as well, right? They only went as far as it was useful to protect also their own business, right? So there is no need to be sentimental about the old days of bank market making. And certainly I would presume that today any market-making firm actually takes a very sober approach and decides very well how far they can actually cushion market developments. So a lot then comes down to the question of what is the price of the liquidity that is brought to the market, in particular in situations of distress. And I think there I'm coming back to, I think Tarek just mentioned it, to the competition in the market, right? That is super important. The more competition the more you can at least in tendency rely on the competing firms actually quoting reasonable prices for liquidity as they provide.
Good, thank you. So, Dylan, do you want to chip into this discussion about the liquidity or
Yeah,
other parts of this?
Yeah, I'd love to. So I think I'd echo what Steffen just said. We should not be sentimental, even in a relatively recent past, about banks' market making strategies and approach, because I think particularly during the pandemic, there was a lot of consternation in the market about the banks pulling back, and there was a debate about the bank regulatory framework and whether that creates an incentive for the banks to pull back in periods of stress. And I think that's something that regulators are aware of and trying to work through as well. And that, that feeds right into the conversation that we're having today about these institutions. But I think a more diverse universe and a diverse set of players in the market who can provide liquidity is probably going to be best for everybody involved. One point, just back to Tarek's remarks, I probably was negligent in saying that I do come at this from a pretty US-centric view, and that's in large part because when you look at the equities market right now, it's become somewhat dominated by the US players, and that's where I focus most of my remarks. I would say that I do think it's a pretty global phenomenon. And it is interesting the way that the Volcker rule, even though it was written in the US, has had an impact on the business model of banks globally. I think very, very few European institutions continue to engage in the levels and nature of proprietary trading that we saw back in the 2009 period, where I was using that as a starting point. So while they're not expressly prohibited from doing these activities, they are, somewhat restricted. And then just one more comment on the differences on capital rules. I think when you talk about equities and liquid trading products on the equity side or ETFs, that's absolutely true. And I think the European capital framework for market makers and principal trading firms is almost indistinguishable from the bank side, at least on a market risk perspective. There are other factors that feed into the banks. So those comments are well taken. I think where it's tended to hit the banks a little bit harder is when they do trading on the liquid side of fixed income products. And those capital rules just tend to be somewhat prohibitive on the fixed income side in rates products, whether that's cash trading or derivatives trading. That tends to be an area where we see, pretty big differences, and that's resulted in banks pulling back quite a bit from what they do, even though they're not expressly prohibited from doing that. So that was the comment there about capital coming through. And I think if you look at the overall landscape right now, we wouldn't view this as a black and white distinction between banks who are in a heavily regulated and low risk set of strategies, and then market makers who are in an unregulated, very high risk taking set of strategies. It's much more of like a comparative advantage story. And I think Tarek, made a very, very good point on that, which is if your only business model is making markets in this space, then you're going to invest appropriately in the technology side of the business, because that's what drives your competitive advantage and your comparative advantage in the market. Whereas the banks have a lot of other things to solve for. And I think that's why, in many cases, they're probably one step behind where the technology is going in this market. And that's a good thing for market efficiency overall. And there's a lot to work through, but I think generally it's a story of comparative advantage and focusing on different areas of specialization in the market at this point.
Okay, thank you. I think we have time for one quick round, and maybe we could focus on.
Shall we let Matthias also speak?
Oh yeah, well, he sort of came in.
No, I think I made a few comments. I think what is important though is we need to differentiate the asset classes and different products, because for me it's very different if we talk about banks and PTGs in the bond future versus repo market. Both is a fixed income product, but one is a highly liquid order book traded product with CCP behind. So a lot of netting takes place intraday. The capital you need to do this business is significantly less. If you that compare it with government bond repo, where we have had some kind of problematic situations in the liquidity from a liquidity side, I think these principal trading firms are not really market makers in these markets. It's really the traditional banks, and here it's about not about technology and electronic, it's about balance sheet. I think that is what the banks have much more, but still they pull this liquidity in stress situations. And I mean, this is where also the US discussion is coming from now with the clearing mandate on treasury and treasury repo markets. And I have been always a great advocate of putting more repo business into clearing, because it will free up balance sheet capacity and allow banks to operate more efficiently during these crunch times when less balance sheet is needed because of multilateral netting capability by moving this stuff through a CCP.
Yes, sorry, Matthias. I didn't want to try to censor you at all.
Okay.
You had very relevant intervention before that, but that was the reason why. So let's just spend the last few minutes focusing on maybe the current situation with all the things going on in the geopolitical sphere. So how does that pose any risks when we look at it through this PTF lens? And I can sort of chip in this. I mean, the firms are heavily reliant on technology. That's one point that has been made here today. So cyber risks, is that something to worry about? So what do you say? Just some quick reactions the last few minutes that we have. So I'll start with you, Matthias, because I sort of censored you.
No, thank you. And I mean, well, technology is kind of, so the cyber risk is definitely a topic. Is that a worry? I wouldn't say it's a worry. We just need to take care of it. And we need to seriously take care of it. We need to continuously improve and make our stacks, our technology stacks, our lines, how we connect, more robust, more resilient, and shield it away as far as we can from public networks and public streams. And I think that is where we put a lot of emphasis on, that we shield all these kind of infrastructures, our matching engine away, and that we have direct connections between the trading member and us, as less as possible from ability to go in via the internet, because this is where kind of the cyber risks are coming in. And so far, this has worked well. So is that something where I'm not sleeping at night? No, but we need to spend continuously investment euros on this to make sure that this remains resilient and robust.
Okay, thank you. So, Steffen, I hear that I just learned that you need to leave at 4 p.m. sharp. So, before you leave, do you have any additional comment on this?
Yeah, no stress. We'll be fine. On the cyber point, I think what Matthias just said resonates with me quite a bit. I mean, you know, probably if we look at potential impacts, right, a cyber attack has a massive impact everywhere where we talk about infrastructures, right? And that is a very focal point, whereas individual market participants is less of a focus. However, I mean, what would be interesting around that topic is, of course, to understand what would happen if a number of liquidity providers were struck at the same time by, for example, a cyber attack, because that would mean that liquidity goes away, and then we'll need to see what happens. So it can be an interesting topic overall. The second one you just alluded to is the current risk landscape that we have. We all know that there is now a discussion on potentially higher price levels, inflation rate hikes in the future. We'll need to see how this plays out. But what we need, because we're today talking about sovereign bond markets in general, what we need to look out for at this stage, that's at least my reading, is that if the current events and potential near-term rate developments, if these take some market participants by surprise, we will see dislocations in these markets again. It happens each time, and then we are back to the question that we had the pleasure of discussing today, namely market liquidity and price provisioning in times of distress, right? And this would be then another case to see how well these markets function these days.
Okay, thank you. Let's go to Dylan then, and then Tarek, who started, can sort of end the discussion. So, Dylan, anything from you on this?
Yeah, happy to. I mean, I think the cyber conversation has come up and intensified probably over the last couple of weeks. And in fact, I was at the Morgan Stanley Financials conference this morning, and that was a topic that came up, I think, from two separate CEOs, and it's clearly top of mind. And I don't think that that's something that would be specific to any part of the industry. I think it's generally a systematic concern. One thing I did want to say, which I think, Karolina, your question prompts an interesting sort of sidebar discussion on this, which is, if you look at another market that the banks have really stepped out of intensively, it's been commodities market making and commodities trading in general. That was largely driven by regulation, but it's also driven by just a decision made by the banks to step out of that market. That is not a space where we've seen a lot of the principal trading firms that we're talking about today step into. And so liquidity provision in those markets is actually quite a bit more fragmented, and you tend to see a lot more volatility in that space. And I think it's a pretty interesting juxtaposition. We're talking about very different markets. We're talking about very different market structures. So it's not a totally fair comparison, but I think we have seen pretty orderly behavior in most of the markets where you do see PTFs active. Whereas on the commodities markets, we've seen some massive dislocations over the last several years. And in fact, some might argue, levels of manipulation in those markets as well. And so I think it's just interesting to take a step back and look at that natural experiment as it plays out over the next couple of weeks and months.
Thank you for that. Well, then Tarek, commodities markets, is that the next thing for you?
I mean, we are active in commodity markets on the listed side, so we are providers of liquidity and commodity options. So we don't, as market makers, we don't really have experience on the physical side, but if we're talking financial derivatives, that's much more closely linked to markets that we, as a traditional market making firm, understand and know how to price. So obviously that's a difference. I think in commodity markets, you need to distinguish a little bit between the physical space, where you don't really see market makers or liquidity providers like Optiver being active, and the financial derivative space, where there is activity of principal trading firms and market makers. But maybe to come back on your cyber point, I think, I mean, obviously from our perspective, it's always a concern. It has multiple aspects to it. One is, of course, there is the constant risk that someone gets access to our proprietary trading information. So that's our pricing logic, our trading algorithms, you name it, our developer information, all of these kind of things. And considering that we develop our own software and hardware solutions internally, so we build our own computer chips and we develop our own software. there's an even bigger risk attached to that from our perspective. So therefore, the incentive has always been extremely high on our side to ensure maximum levels of cyber protection, that we don't jeopardize our business. But more broadly, what we tend to be concerned about is the resilience of infrastructure that we trade on, which I think over the last multiple episodes of stress in the market, we've actually seen pretty resilient infrastructure. There haven't been any major outages. I mean, there have been outages here and there, but we haven't seen any major infrastructure collapses, which has been good news from our perspective. But yeah, I think more broadly from our side, there's definitely a move towards bringing more development of whether it's software or hardware in-house to be less reliant on external providers. Whether that's, building our own trading chips to building our own data centers and so on and so forth. It's just around being more resilient to any external shocks.
Well, thank you for that. I think that's all we could muster today. I think this was an extremely interesting webinar. I've learned so much today. So a very warm thanks to all the panelists, and of course also thanks to our hosts, Martin and Ernest, and of course also Ernest's participation through the chat with all kinds of interesting questions. Yeah, thank you all, and have a great continuation of the day. Bye-bye.
Thank you very much.
Thank you very much.
Thank you. Bye-bye.
Thank you. Bye-bye.
Thanks all. Bye.